Through the FX prism, I want to start by asking you about the dollar and where you see it going. I've been looking at a chart that shows it, from a technical perspective, oversold at this point. Does that have any bearing? Where do you see the dollar heading now?
Well, I'll be honest with you, Anna. In the short term, who really knows? It is oversold, yes. It may bounce, it may not bounce. Honestly, I think right now the situation is so unpredictable in the short term, at least, where new cases ex-China are being announced and the markets remain jittery. So it makes it extremely difficult. It actually makes any short-term framework being thrown out of the window. I think one needs to keep a cool head. Obviously acknowledging that there's a great deal of uncertainty, but at the same time maintain a medium-term view. And our medium-term view has been for a few months now that this year is going to be a year for dollar downside. Now, what has actually changed this time around, which actually compounds to this story, is this massive drop in yields. I mean, when I think about it, 10-year paper in the US is giving you 80 basis points. This is just unbelievable. We're talking about more than 100 basis points of decline in the space of just 2 months, really. So that's really bound to start exerting some further downside on the dollar.
Vasileios, you live in the FX world. So, when I look at dollar strength, dollar weakness, there are a million things that could be driving it up or down. What is it that leads most to dollar strength? Is it traders actually trading pairs? Is it investors switching to dollars because they want to buy 10-year yield or 10-year paper, or to buy U.S. stocks? Right. I mean, what drives it for real?
Well, it's really a combination of things. First of all, one of the major things historically that has driven the dollar is the growth rate differential, especially if you look between the US and the Eurozone, or even if you look between the US and emerging market growth. This is typically very much correlated with the dollar, meaning that the US is outperforming the rest of the world. What you get is that you get flows both into equity and to fixed income into the US. But what has happened, and what has also been very distinct this time around, has been, at least as far compared to the G10 countries, is that most major central banks as G10 have actually gone negative. And basically what this did is actually distorted the traditional relationship of interest rate differentials. So when the countries with the negative went into negative, what really mattered for investors was actually only the absolute level of the positive yield that they were taking in the US. And that is why, not just us, but on various houses out there, the dollar looked very overvalued when you looked at the relative rate differentials. But that's because the other side of the equation, the shorting currency, didn't really matter because it was in negative territory.